Well, the new Dow is going to be a $50 billion company. It's in packaging infrastructure and consumer goods, as you say. It's more focused. It's focused on 3 market verticals. And in those businesses, these are all big, high volume, very capital intensive businesses. So we have to be low cost and we have to be best in class. We have to have a culture of benchmarking inside the company that makes sure that we're able to be competitive and deliver the highest returns for the shareholders. And so as we've gone through the DowDuPont deal, we've really had a chance to take a look at all 3 of these divisions and design them for the future. So this isn't just about merging 2 companies together. It's about creating from the ground up 3 new divisions, and that's allowed us to take a look at all kinds of things like our structure, our lean corporate cost structure, and get that corporate cost down to where it's competitive with our peers. But we also have to look as we move forward with the businesses at our investments and making sure that they're low-cost investments and they're going to be the highest returning projects in the industry.
For example, I mean, people do look at the deal you've done with Aramco, Sadara. I think you spent, what, $20 billion?
That was a big venture, right.
That's a very large venture, new petrochemical complex, of course, in Saudi Arabia. When people look at the return on invested capital there, should they make any assumptions in terms of how that's informing your future decisions or what the new Dow is going to do when you look at opportunities like that, or perhaps avoid them?
Right. Well, we've done 2 things in this time frame. We've invested in a large group of assets in the U.S. Gulf Coast to take advantage of shale gas, and we invested in our Sadara joint venture. Part of the strategy was we viewed that the U.S. would be a base to service more the Americas, North America, Latin America, and we viewed Sadara as being a base to service growth in Asia, Middle East, Africa, and a little bit support our European business. So we look at it, obviously, as a return on capital from a JV standpoint, but also a return on equity for our shareholders' equity into that business. It was $20 billion to build it, but it was 26 manufacturing units and a supply chain to service all those markets. So on that scale, it's a massive scale. It's a big undertaking.
Enormous, right? But when are your investor base going to start to see a significant return on that investment?
They're starting to see that now. They're starting to see year-over-year improvements now. So this year we're going to have about a $250 million year-over-year improvement from last year, and that's going to continue. At the end of this year, we'll finish a lender's reliability test, which will allow us to look at the financing and the covenants around the financing, which will help us as we move forward in the new venture. And then as we move on, we've got a base to do other things from. Obviously, as we grow out the Asia-Pacific business, we can look at how we can add on incrementally, bring more capacity out. Right now, as we look at our future growth, we're looking at more brownfield, organic, lower capital intensity, higher return on invested capital investments. And those will be a faster payback for investors.
And finally, to the portfolio itself, as you emerge as a newly public entity 6-7 months from now, I guess, in April, how should investors sort of think about the portfolio of businesses you have? Is this what you want? Is there further streamlining to do? Is there perhaps the opportunity to do merger and acquisitions?
Well, the structure of the portfolio and the portfolio that we have today is very powerful, and we're very happy with it. We think it's going to be one where we can be a world leader. And we have great positions in packaging. We have great positions in our infrastructure and our consumer business. In fact, today we just announced some incremental expansions in our silicones business to keep up with the growing demand there. So I think when we look at the portfolio, everything fits today. What we need to do to increase value for shareholders is to continue to look downstream. So we have 2 ways to make money in this business. One is innovation and growing downstream with the customers, and there are huge demands that brand owners put on us every day. And one is cost position. We've got other players coming in that want to play in the low-end commodity space. So for a company like ours, we need to continually innovate to keep those margins high for our shareholders.